we're backed up. Okay, so just from a housekeeping perspective, if something should happen to my line, I don't think the program goes down because George Roberts is on with me. Special thanks to George for letting me use his GoToMeeting software, or excuse me, in this case, GoToWebinar. I will be doing a presentation that's different than I normally do, and then I'll close the last 45 minutes or so with basically doing what I post with the top-down review live. It is being recorded. I have 2 monitors, so I'll be looking at your questions. I know that if they are software-related issues, then typically George will answer them for you. And if they're investing related or things that get by George, then I'll take care of them. So again, appreciate you coming by. I also want to do a special call out to the people. There's 2 or 3 meetups that are canceling based that I invited folks from. So you may be new to this. You clearly won't be new to investing, but you might be new to some of the vocabulary. So I've tried to do the first part of the program sort of to answer a frequent question I get, which is, can you go over those indicators again and show us how you use them and how you build your chart? And so I thought I'd be able to, and I will be able to, give you sort of the basics of the philosophy behind HGSI trading, which many of you will soon see is very similar to CanSlim with a couple of twists, and do that while I show you how I use the program. I entitled today Santa versus the Hindenburg Omen Part 2. Those that may have watched one of the last 2 weeks, I turned quite bearish last week and a little bit bearish the week before, and talked a little bit about oil and what was going on, but drew attention to the fact that we'd seen last week a weekly Hindenburg as well as a number of other Hindenburg signals over the last several days, and we'll talk a little bit about what that means. We're not supposed to be having the market blow up here as the Hindenburg did. We're supposed to be getting ready for a Santa Claus rally, and we'll talk about maybe handicapping those. So without further ado, and again, thanks for being here. Let's get started. You got to always have the fundamental disclaimer. This is for educational purposes only. Anything I recommend in the spirit of education should not be considered investment advice. I'm a doctor, not a broker. Most physicians lose money with their investments. I am independent. I have initially paid for every program that I have that I use, including HGSI and EdgeRater and others. I'm not paid by anybody to say anything, and anything I say is or show you is exactly what I do on my own. And although we'll be talking about a number of commercial programs, this is not about being a commercial today. This is about showing you how to trade and some of the tools that I use. And then lastly, something that I recently added because everybody else does, and that trading does involve risks, especially if we talk about options. Won't be talking about futures or Forex here, and you alone are solely responsible for any investment decision that you make. This is actually, for me, a very important slide. And those that have been to the live meetings that I put on or I participate in, I think have figured out that I'm sort of, oh, there's nothing on the screen yet. Is nobody seeing the screen?
Yeah, I was just going to ask you, Jeff, because I'm not seeing anything here.
Oh, you know what? No worries. Can you guys see the screen now?
Yes.
Okay. Well, good thing, because this is the only slide that you missed was the disclaimer. So again, this is Jeffrey Scott. It's 12/14/2014, and the title of my program is Santa versus the Hindenburg Omen. And disclaimer, I already talked about. And so what I was saying before you guys pointed out that I had messed up and hadn't showed you the screen was that the way that I like to teach and the way that I've learned myself is that I want you to become your own guru. And I want you hopefully to find out what I found out, which is that you're the one that's responsible, and that it's your responsibility to learn. Now, you could give your money to other people to manage, and certainly most people do, although probably not people that are on this call solely. And unless you want to be like my buddy John Person and create new indicators, you're going to be like me, which is getting a couple of pieces of software, learning enough to hopefully not be too dangerous, and then applying what you learn to your own trading. And I kind of call it becoming your own guru. I don't claim that I have created anything. I have created the bongo as part of a group, but that's an afterthought and not anything that is going to be a big discussion tonight. So I will take credit for that. But for the most part, as I've created my own style by learning from other smart people, starting with Ian Woodward, who I met in the early 90s, and his sidekick, Ron Brown, who left the audience and became a teacher probably 10 years ago. And Ian is a great guy. He's still out there teaching, and I owe a lot of my success and a lot of the money I've made to him. And Ian really got his start by listening to some guy named William O'Neill on the radio. And I kind of look at what Ian has taught me to be sort of along the line of being applied can swim, rather than perhaps just what O'Neill has in his books. Now, I'm a big fan of O'Neill, and you could see up on my wall of the folks that influenced me, Ian and Ron, Bill O'Neill, who I'll talk a lot about in the next couple of slides, Gil Morales and Chris Katcher. I will talk about them this evening. They've got a book coming out about short selling, which would have been nice to have been out already, considering the timeliness of what we're dealing with in this market. They also did a recent video. I think it was taken down from the E-Trading Expo, but if you have that or you can get that, it's a good idea. This is my buddy, George Lee. He's got a webinar at 9:30 tonight, so my goal is to make sure I'm done and take my dog out eventually so I can watch his webinar. George is just a great trader, and I've had the luxury of getting to be friends with him over the last couple of months. Alexander Elder, went to one of his live meetings. These are his books, all about position sizing, a little bit of money management, and when to take the trade and how to make the trade, how to do record keeping. Van Tharp, Position Size and Money Management Extraordinaire, big book. My buddy John Person, I kind of layer him on top because he's really taught me a lot of when to take the trade. A little bit of how to find stocks, and there's a lot of overlap with what I do. He's all about the market first, the sector second, the stock third, and he loves to buy stocks that pull back to support and have momentum, which is my favorite kind of trade. And then I've gotten kind of excited by volume price analysis, and rather than going out and spending a lot of money on programs that probably don't work very well, I found that Anna Cooling, and you could buy her book on eBay for less than 10, or on Kindle for less than $5, was a good thing to use. So this is really the team that I rely upon to build my style. And then you might be surprised to see this guy here, Thomas Dorsey, on point and figure charting. Don't be too surprised, because he may chart things differently with point and figure, but he's all about comparative relative strength and comparing cash versus bonds versus the equities. If you're in equities, comparing big versus small, Russell versus NASDAQ versus Dow, then looking at sector analysis and picking out which sectors are leading, and then finding the top stocks in the various sectors. Frankly, I listen to that and I say, gee, that's exactly what I do. And I found his book to be very interesting. I'm sort of suffer from an affliction of I haven't met a software program I haven't bought yet. And my desktop is really filled with these. Hopefully you're smarter than me and haven't thrown away as much money as I have. At the end of the day, I don't need a lot of programs. I need something to trade with. And Genesis is a different story. It's a great real-time platform that I have some things in that I can't do in the others, but I use TradeStation or Thinkorswim. I use HGSI for my after-hours analysis, soon to be in market with delayed quotes. I use EdgeRater for a lot of my market analysis. I use Magenta and Best Choice for seasonality. And then I have a number of websites, including investors.com and MarketSmith, as I still am a big fan of O'Neill and Cancelin. What's most important to me is the market and where are we at. And I usually spend a few minutes talking about this graph. This is tough because if you've only been trading since uh, 2009 rather, March. Hey, George, I think I'm mute. Okay. Only been trading since March of 2009. Then you've been living in the stage two, and we haven't experienced a bear market in several years. We've had a number of going over the shoulder here and feeling like we were entering the fourth stage, a bear market or a deep pullback, and we've quickly snapped back into an uptrend. You know, is it different this time? Are we about to enter a prolonged down phase? Maybe, maybe not. We'll look at some of the data to support it. So we've been living kind of at the top of this, and every time we've gone over and looked like we were heading down, the market had another leg up. And we're at a position where in the next few days we might see that again if Santa's going to come and visit us. I promise this isn't a sales thing, but there are a couple of slides. This is a meeting that George Lee and I are doing. We're doing it in Palm Beach Gardens. We decided to move it off the beach because it was too expensive on the beach for hotels. And it's 3 days, February 7th to 9th. If you like the stuff we're talking about today, give me an email at hgsidoc@gmail.com and I can give you more information. It's also important, and I always start my review by looking at, are there any special things that can come out during the week and slap us in the head on the market? And so I go to Leave It Brothers, and this is for free, and I get the key economic releases. There's always some claims, continuing claims. Those are important these days. CPI has been kind of boring, as has been PPI. Eventually, it's going to start popping up, and people will care about it. Housing starts and building permits might be important if you're into housing market index. What got a lot of people this week was the crude inventories, where we had another whammy, not just prices falling, but we got supply numbers that came out with more supply than thought. I also need to know if anything has earnings that I own. Now, I use an indicator in TradeStation, which is free, that tells me the earnings date, and you can also see it in HGSI. But I like to look at this, and I noticed that FedEx, Apogee, Oracle, some of the bigger ones, some KB Homes that come out this week, Worthington Industry, Nike, BlackBerry, like we used to care about that one a lot. So that's important to know as well. So as I started before and said, the agenda tonight, just to review, I'm going to spend probably the next 30 minutes or so going over what high growth stock investing is, comparing it a little bit to CanSlim, also reviewing some of our unique indicators and scanning tools. And then with that knowledge in hand, then I will jump into my market analysis that I post on YouTube and on the High Growth Stock blog on a weekly basis. And because top-down isn't always enough, I like to do a little bit of bottoms-up analysis as I go as well. So a little bit about the difference between the philosophy of HGSI and the tool. George, Ian are smart men. However, we have a problem, and the problem is that the software is known as HGSI, and so is the way of trading is also known as HGSI. And so to me, that's a problem. And I like to call one the trading philosophy and the approach to trading, and one a tool that you can use to make it easier. But it's really about, to me, the HGSI trading philosophy is what came out of these two brilliant guys on the right-hand side. What I try and teach an active community of traders and a great software tool. But it's really the philosophy and the tool are separate things. And HGSI is all about balancing the best of value and momentum and coming together in what's called growth investing. And for the CanSlim IBD fans, it's a lot about the stocks that are in the IBD New America. It's kind of funny from a historical basis. A lot of the things that we did in HGSI were to front run IBD. For example, we would do our industry rotation from a top-down perspective, find what the leading groups were in the leading stocks, because the Friday weekend review, which is the top stocks and the top industries, I want to know what it was on Wednesday or Thursday so I could trade them before everybody else found out what they were. We have an HGS scan that identifies similar to stocks that are in the IBD 50, so we can be updating that on a daily basis. So there's a lot of overlap between the two. I can't say enough positive about O'Neill. I mean, if you haven't read his book, shame on you, you shouldn't be on this webinar. There's a lot of smart people besides Ian. You got Gil Morales and Chris Catcher, you have Dan Zanger, Amy Smith, and many more that learn their stuff. Mark Minervini, I suspect some, and certainly David Ryan's another that seem to have a strong O'Neill influence. He's a publisher and editor of IBDinvestors.com and MarketSmith, at least in the family, author, and there are a number of books for those of you that are not ready for the Orange Book about getting started with how to make money in stocks. And if you haven't read it, it's certainly a smart thing for you to do. Now, William O'Neill has taught us about canceling. And those that are can-slimmers know exactly what those letters stand for. The C and the A are about earnings, both current and annual. It's about new products management, new highs. It's about supply and demand, leading stocks and leading industries, institutional sponsorship, and what the market is doing. In HGSI land, we've made it a little bit simpler, and we call it, and Ian taught us about ERG, which stands for earnings per share rank, relative strength, and group rank. And we use these three to give us sort of a temperature of the can-slim strength of individual stocks. Now, is it pure can-slim? No. But if you look at the EPS rank, takes care of current earnings and annual earnings and increases. The relative strength is all about leading stocks, supply and demand, new highs, institutional sponsorship, and group is all about the leading industries. So it really gives a great tool, and it's all searchable, reproducible, and the nice thing is it uses the same philosophy of a lot of numbers that I might see in IBD. There are programs on the market, I won't go into specific names, but they use a lot of made up things, and they're probably similar. I like the fact that I understand what goes into these numbers and that they are the same across print media, the internet, and within the software. I'm sure they're calculated differently. They may not be exact because you have IP protection, but directionally they're very similar. I'm not going to spend much time into this chart, but this is really for the can-slim folks that have taken time out of their, a lot of them are West Coast, out of their afternoons to come here and showing you that it's all about the earnings on the fundamentals. I'm not going to go into the 9-box matrix. It's one of my most exciting things to talk about, but you can only do so much in one night. Optics, there's actually a score that looks at current year earnings and revenue in current quarter, the growth. It's about the technicals. We use moving averages. I'm a big fan of the 1750 and 200. I use those on my daily charts. I also use an 8 exponential, which I learned from Steve Bigelow. And we have chart patterns. We like tight charts. We like cups and handles. And then in Ian's vernacular, living out in LA, he likes to buy halfway up the right hand of the cup. And he calls that north of the 405 freeway, which I guess if you lived in California, you know how that bisected the city. So the next few slides are, I think, part of the power of the philosophy. And you could build these into any program, but they're built into HGSI. So as a can-slimmer, an IBD fan, I'm well aware of the term follow-through day. And I know that it's something around the ways if the market had a big day today, then there's so many days forward where we're allowed to look. And if the market has a up by 1% on higher volume, I see a lost audio. Everybody else can still hear me? Type in a Y. Okay, all right. JC must be on your side. Thanks, everybody. So we know what the investors.com and IBD follow-through day is. I don't want to think that much. I want to look at colors on a chart. So in HGSI land, we have the Phoenix and the Eureka. And you'll be able to download the video, and you'll see in the video that the Phoenix is determined by looking at advanced declining issues, advanced declining volume, and the ARMS index. So is the Eureka. And these are reproducible tools that give us our follow-through day to the upside in green and to the downside in red. And just as you might think with a more traditional O'Neillian follow-through day, after a long run in the market and a big up move, a follow-through day might be the last person buying stock, and it might be the end of that run. So we know that a Eureka at the end of a long run might be some irrational exuberance, as would be the Phoenix after a long drop. Now, in reality, I don't want to remember all that mumbo jumbo. As I said, I want to look at a chart. So this is the simplest chart you'll ever see me put up. It's a price and volume chart, and I'm going to build on this chart so that when I go into the market, you're going to know exactly what I'm looking at. I have candlesticks, which is my preferred way of looking. I have an 8-day exponential in purple, a 17 and a 50 and a 200-day simple moving average. And then down here, I have on balance volume with a moving average. I think it's a 10 period. I can't remember what I put on this chart. And then what I want to pay attention here is the Eurekas in green and the Phoenixes in the more maroon color. And I want to look at this period right here, which corresponds to the mid-October low that the market made. And what we saw was the market made a low, had a positive day the next day, and then, whoops, the next day after that followed it with a Eureka. And that kind of gave us, it's time to get back in the market. Now, you may have gotten in earlier based upon the candlestick pattern, but imagine if every time that you had this all clear sign, you painted green. That might be a useful tool. Now, the Phoenix fired up here and fired again down here, and it was a little late, but it gave us an idea that the market was down. Now, whenever you see the Eureka and the Phoenix on a chart, it is only calculated on the NYSE. So I could be putting anything here, and if you see a Eureka and Phoenix, it tells you what the NYSE is doing, and that gives you, I think, an idea of what the market in general is doing. So that's a Eureka and a Phoenix, and we use them once again looking for follow-through days to the upside in green and in the downside in the maroon or red. Now, building upon that, the next thing I want to talk about is our signal for capitulation. Now, we can all talk about what capitulation is. It's that really horrible day when the market's down 300 points on big volume, every one of your stocks are down, and it's that proverbial throw the baby out with the bathwater day. Well, there are capitulation days for the market, and there's capitulation days for stocks. So our tool for capitulation is called the bingo. The formula here is a Wilder RSI, percent B, percent A and D, and basically it paints a gray bar. Now there are, I think, 2 or 3 bars here, and if I go back to this last chart, it's going to paint capitulation right over here. So I had the market capitulated, and then I had the Eurekas afterwards, which would have told me definitely get in the market. And in fact, if you go back to some bad days in the past when we had Hindenburgs in 2007, 8, and 9, you see how what we looked for at the market bottom was not just a bingo, because the bingo by itself is just capitulation. And here's a series of bingos where there's no Phoenixes or Eurekas popping up. And then we had the big capitulation at the end of 2008. And then all of a sudden we start to see some Eurekas. And for many of us, that was the signal to get back in. We'll find better examples. If I want to look for stocks that have been beaten up and maybe have bottomed, I will look for stocks charts showing that bingo, followed by a Eureka. So that's the second indicator that we add to the charts. The third indicator is called the bongo. And this is one that I was involved in creating. And we were tasked by Ian to find an indicator that we could use as a market timing tool on the major market. Turns out it works for individual stocks. Now, to be honest, it's slow, but if you're what Ian calls a type 4 investor and you don't do a lot of trading and you want to capture most of the up move and get out before the market gets hammered, the bongo has been a very useful tool. I use it as a filter. I use it as a filter because if I can find stocks where the bongo daily and weekly are green, I know that stock's in a nice uptrend. If I find stocks where the weekly is green, but the daily goes red, then that tells me there's a retracement, and I can scan for that as well. So this is the calculations for the bongo. They are a timing model that we use. We tested it over multiple markets. And again, you're not in early and you're not out early. You're in a little late and out a little late, but you capture the majority of the move. And it gets you out before much pain. So here on this little chart, and I know it's hard to see, you can see on the NYSE, which is the same thing I've been looking at with the bingos showing the capitulation in October, the Eurekas, not quite a new high here, and then rolling over, that not only have we crossed over the on-balance volume moving average, but we've now painted red bongos that goes along with a market that is in correction and potentially more. Hopefully you are aware of the force index. This is not something that's from HGSI, nor is this something that I'm aware of being used much with CanSlim. But the force index is a tool from Alexander Elder. And what it does is you look at today's volume times close today minus close yesterday. So, and then you plot that. So when you plot the force index, you're basically plotting a curve that goes up and down a lot. And the big drivers are volume. So the more volume you have, the more your force is, and change. So if you have a stock like Bank of America or JP Morgan, or that group that they're in that trades tens of millions of shares a day, their force is always at the top if you look at the height of the force. And for the most part, I look at that for group rotation. When I look at a stock, it's similar to how I look at the bongo, in that I'll put a 13-day moving average, and that's my long force, and a 2-day moving average, which is my short force. And just like with the bongos, when the long force is green, as it is up here, where my arrow is, I'm in an uptrend. And when the short-term force goes red, it signifies pullback. So if I was looking to scan for stocks in a long-term uptrend, I'd be looking at a green 13-day force and trying to capture them when they had the 2-day force go red, telling me that this is the right time to be looking, not necessarily pulling the hammer. When I look up here now, and I think about the NYSE, I'm a little bit nervous because my weekly and daily bongo have gone to red. My 13-day and my 2-day force index have gone to red. And in the middle here, my accumulation distribution has gone to a C, or neutral, but it went from accumulating to flat, and we know what comes next if it keeps going down. So I can look at any chart, and I can get a sense of the technical strength of their uptrends, their distribution. I can understand what the major market as measured by the NYSE is doing, and I can see if there's been recent capitulation just by looking at colors. Now, I love looking at charts, and I look at a lot of charts during the day, and these colors allow me to go very quickly. Now, I did want to mention another major indicator that I use, although I have to admit I was losing faith in it, and that's called the Hindenburg Omen. So the Hindenburg Omen is really what the last 10 days have felt like. It's, the market just sucks. It starts by going up, then it goes down. My stocks are doing worse than the indexes. I don't understand. And what it is the pros are suckering us in to buy, and they're selling. And so what you'd expect to see is lots of new highs and new lows at the same time. You expect to see the moving average of the NYSE to be rising, but the McClellan oscillator is negative. Those four things, daily number NYSE new 52-week highs and lows, both greater than 2.2%, at least more than 79 on the smaller one. NYSE 10-week moving average rising, McClellan negative, and the new highs cannot be more than twice the new lows. When you hit all of these, you meet the criteria for the Hindenburg. Now, there's lots of variations about the Hindenburg that I've seen in the press of late, and but I also seen it in a lot of places, which suggests to me that people are paying attention to this. So here up on my chart, and again now, without adding much, I added the Hindenburg omen to my chart, which gives me further reason to be concerned. My technicals have gone red. I've had Hindenburg omens, and my stock, the index here is dropping. Now, if you're not a believer of the Hindenburg, that's okay, because 1 out of 4 is when it works. The other 3 out of 4 times, there's just small corrections. But if you go back to the Black Swan time, we had a top here in the summer of 2007. I remember I was with my wife in Italy, and we had the Hindenburg come in, and Ian was like telling all of us we need to pay attention. And the market sold off fairly hard, 14% drop in 24 days. We had the bingo, we had some eurekas, and the market went back up. But it went back up, I guess it formed a new high, and this here is the NYSE again. But after sort of a double top, we started getting a lot of these Hindenburgs. And you can see what happened, a 20% drop in 56 days. And that was the beginning and not the end of the Black Swan. So the usefulness of the Hindenburg omen is to help us identify and get us out of the market, or at least make us aware that there's more volatility coming in and more risk coming into the market. And you see I'm just building upon each indicator here and adding them to my picture. The next one I use is one of my favorites, and I'm a momentum guy. I want to find stocks in an uptrend, so the weekly bongo green, the 13-day force green. I want to find them pulling back, so I want the 2-day force and the daily bongo being red. But then I want a clue as to something is happening, and I could look at volume, but I could also look at these things called the kahunas. And one of my favorite scans, and everything I show you on as a chart indicator, I can scan for and also put into a radar screen as well, and monitor real time during the day in TradeStation and Thinkorswim. So the kahuna is defined as this. If you give me a little bit of Ian poetic justice, he took the Bollinger Bands and he made them the top and the bottom of a cup. He set percent B of the lower band, or the bottom of the cup, as 0, and percent B at the top of the rim as 1.0. The middle is 0.5. Now, almost every trading program will have percent B. And then what Ian did a lot of research, and he found that if you move up 24% within this cup in a given day, that's an unusual event, although they occur more frequently today. But if you move up more than 40%, that's a big move. So we code for these so that I can be monitoring the market. And now if I see those bongos and force changing, suggesting a pullback, and then I monitor those stocks for a kahuna, I might see momentum coming into a stock during a period of basing or pulling back. And the kahunas can be up in blue or down in red. And you could see down here, I've now added a regular volume window, which I don't use, frankly, because I think on-balance volume is a much better tool and seems to be better now that, so often I hear people saying volume's not working for them anymore. whether it's dark pools, whether it's options, whether it's ETFs. I think a lot of the volume that we measure is coming out of the numbers. And so, and we're going to go into big charts in a few minutes. I want to do the definitions now. So the kahuna is plotted on the bottom, and this is a new momentum indicator. So I'm looking for example, a pullback that's occurring here, and I want to get back in when I fire my kahuna showing momentum. Now, we'll go much more detail to that as we do our top-down review, but at least now I can say I've showed you what the kahuna is. There's another thing that we do with these Bollinger Bands. The way the Bollinger Bands are made, somewhere between 90 and 95% of the movement of a stock will be captured within the Bollinger Bands. That's just the definition of the bands. So that tells me that if I'm above or I'm below the band, that's an unusual event, and it suggests that perhaps I'm likely to revert to the mean. And now there's people like Larry Connors and others that have made a whole living about reversion to the mean. So what we do with HGSI, which I think is just a very smart way of understanding the ups and downs of the market, is we subject the S&P 1500, run it through a filter, and try and understand how many stocks are above the bands, how many are below, and then how many are above and below the midline. During an uptrend, most of the stocks pull back to the middle and go up to the upper, to the middle, to the upper. During a downtrend, it's the opposite. So that's something that I'm aware of. But if I find 20 or 30% of the market sneaks down below the lower Bollinger Band, I know from research that this is a market that's going to bounce. And if 20 or 30% of the stocks are trading above the Bollinger Bands, there's a good chance it's going to pull back in. Now, in the bull market, it just meant sideways, not necessarily a collapse. And we use EdgeRater. I use EdgeRater. It can be done in many different tools. And then what I basically do is I run the S&P 1500 in, and this is where it sat on Friday, and it showed me that 70% of the stocks in the S&P 1500 were trading below the middle of the Bollinger Band. That's a negative, and it's not an extreme negative. But 20% of the stocks are underneath the lower band. So it may be different this time because it's a lot of energy stocks that have been killed more than the market. But we're starting to get to a point where I start to think about a reversal. If I look at December 1st, this is when the energy stocks showed up here blowing up, where 18% of the stocks were in the S&P 1500 were below the Bollinger Bands. And I looked at what they were, and they were predominantly energy related. Now this is what down here in the lower left is what happy days are. And this was the market on October 31st. And it showed that 91% of the stocks were above the S&P, were above the midline on the Bollinger Bands, and that 25% were above the bands, 30% were right under the bands, and that was a pretty good indication that this market was going to pull back because over half the stocks were within 10% of their upper band or above it. If you want to see what pain looks like, this was on October 13th or 11th, and it showed that 35% or more of the stocks in the S&P 1500 were trading below the lower band, and 83% were below the midline. Okay, well, what does this really mean? Well, I did this summer, and I looked at every time the market hit an extreme, and then I plotted these on the chart, and I'll be darned, within a day or two of an extreme reading to the downside, the market bounced every time. Little bounce, more extreme, big bounce. Pull back. I put this in a post. I said we're going to bounce within 2 days, and we bounced the next day. And in the bull market, at least, overdone to the high end, to the top end, has not led to a big pullback. It's led to smaller corrections here and a little sideways. So these are some of the tools that I use to understand the market, and the market is the M in canceling. Now, I want to build a little bit more on what I've taught you or confused you and bring in a couple of other tools that I use and hopefully you're familiar with. Not a good picture, but great books, at least the first two. The third one's sort of which is a good book, but it's a lot of different authors. These are the two currently published books from Morales and Katcher, the O'Neill Disciples. And now, the first time I saw this, it says how we made 18,000% in the stock market. It's blurry on my end too. It's a picture. I walked away and laughed. Yeah, right. Well, they did. And the book tells us how trading in the cockpit is sort of this book Redux, where Mike, I'll show you. I use it with Edge Raider, and it's simple to do that. I can show you all that when I get to into the programs. So I've incorporated two of their big contributions. You can go to the websites, Virtue of Selfish Investing. You also have GilmoReport.com, and you can learn more about these if you haven't read the book. But here you go. This is the 10 Commandments of Pocket Pivots and the characteristics of Bible gap-ups. Again, I will put a link up for this video that you can all have, and you can stop your own video and you can write it down if you don't know. Suffice it to say that although they worked with O'Neill for a long time, they're concerned, and I'm paraphrasing, and it's not what I'm interpreting, not what they're saying. I am interpreting that they're saying that too many people follow CanSlim and cups and handles, and by the time they're occurring, a lot of times a lot of the move has already started to occur, and that they're looking for less popular earlier signals that they might be able to get in and add to positions. And they use pocket pivots, which is basically a combination of a small pullback into the 10-day moving average, as well as the highest volume in your direction compared to the volume in the other direction over the last 10 days. Bob, you'll get the video on Trade Like an O'Neill Disciple, Trading Cockpit with the O'Neill Disciples. They're both on Amazon.com. Highly recommend them. So a pocket pivot could be another momentum signal suggesting to me that I want to get back into the market. A Bible gap up is a great tool because we all can wonder about gap ups. Do I sell the gap? Do I buy the gap? What's an exhaustion gap? What's a breakaway gap? Too much confusion. How about a simple tool that says if you gap up more than 75% of the ATR of the 40-day ATR, and you have 150% of the 50-day average moving average volume, then you have a Bible gap up. And a Bible gap up has specific rules for trading and a high likelihood of success. And when you start to see them fail, it's usually a sign that the market is doing poorly. Now, I'm not going to go more into the mumbo jumbo of what these are, except to say, would you be surprised if I told you we've incorporated them into HGSI? So up here, I've added a new column or a new line to my technicals up here called a Bible gap up. And when you get a Bible gap up, it paints green. Now, I don't have the NYSE here. I don't see a whole lot of Bible gap ups on the indexes. But I put one of the big performers in from this week, which was Adobe. And so had I been scanning, I would have found early in the day on my trade station that Adobe had a Bible gap up. Now, the nice thing about Bible gap ups is they're a complete trading system that they've developed, and they have rules about stops and how long you stay in the position, and I highly recommend you read the books. Now, let me point out a couple of other things on this chart of Adobe. So this is sort of in an uptrend. It's been pulling back. I like to see it more of an uptrend. It's a little bit loose for my taste, so I wasn't looking at it. But what happened on Friday was I had a Bible gap up. My force indexes and my bongos turned green. I had a pocket pivot, and I had a kahuna. Oh yeah, I forgot to tell you. I added pocket pivots down here. Now, a couple words of advice. They do a 5-day and a 10-day pocket pivot to the upside. They never talk about a pocket pivot to the downside. I don't know if it was my friend George Lee's idea, whose idea it was, but if pocket pivots to the upside are that meaningful, then maybe to the downside they might alert us to a change or something to short. So we plot here pocket pivot. So is this a busy chart? Absolutely. How long does it take me to look at it? I look up here, mostly green. I look down here to see a Eureka or Phoenix. I don't see one. How about pocket pivots or kahunas? Then I look at my moving averages and I go on to the next chart. And I can go through charts very quickly because I'm looking for pattern recognition, of which price and volume is just one of them. And then the last guru that I'm going to incorporate in my charts before I start to attack the market is David Elliott. David's, I think, been gone now probably 2 years. I was really lucky. I was doing a business trip out in San Francisco. I checked into my hotel. I think it was the Hyatt by the airport. And I saw a sign that David Elliott was doing a free seminar. So I went to his free seminar. Yeah, it was free, all right. I bought his advanced trading course, 4 videos, 5 indicators, and it cost me a couple $1,000s. But it was money well spent because the guy was a master. And you'll hear me talking about MOBO breakouts, breakdowns. George Lee likes to talk about them. Here's the definition. Suffice it to say, because I'm not going to go through the whole thing, it will never get finished, that these are a way of channeling some adjusted settings of the Bollinger Bands and actually building buy and sell signals. The Bollinger Bands are not buy and sell signals. They're volatility bands. When they get close together or they travel inside the Keltner channel, it's sort of a spring setting up to go with power up or down. But the MOBOs are actually a breakout signal to the upside or downside. The squeeze is something that Elliott used. I know that John Carter uses. His is different. Everybody uses the traditional Bollinger Bands going inside of Keltner channels. And when the bands are inside the channels, so the volatility bands are inside the ATR bands essentially, that you create a squeeze. And a squeeze is a period of contracting volatility, and major moves occur with a breakout from a volatility squeeze. John Carter adds a momentum indicator to his, and that's why his is more complicated looking. So let's go back to my chart, and now you should know. You should know that this is the Hindenburg. This is Adobe anyway, again. That I've got my bongos are green, which tells me that capped formula, the wild RSI, my timing model is in an up, is a buy. My accumulation distribution is not, A is dark green, B is light green, C is yellow, D is pink, and E is dark red. So we still got D accumulation, which isn't great. I had the forces turn green. I have a Bible gap up occurring at the same time as a MOBO breakout here from a squeeze with a pocket pivot and a kahuna. So if I was somebody that looked for signals based upon how many positive findings I have, this is a home run stock. Now, whether I buy it or sell it, I got to look at other things. But I want to be able to use these to quickly look at charts, but also to scan to find the types of stocks I want. And I have one last indicator, I think, to kill you with. And this is our personal high growth stock ATM machine. Why is it an ATM machine? Well, I don't go to an ATM machine. I have a wife who cashes checks for me. And that wasn't supposed to be sexist. But I have 2 children that do go to ATM machines. And why do they go to the ATM machine? To get money. They take their money out of the bank. Well, when do you take your money out of the stock? So Ian introduced us to this years ago. I think this is something that, to me, it's probably one of the most important things that he's come up with. And it's a measurement of extension away from the mean. And if you think about a rubber band, if you keep pulling that rubber band and pulling that rubber band and pulling that rubber band, it ultimately either is going to snap back or it's going to break. Well, stocks don't usually break. When they get too stretched out, they snap back to the mean. So there's different formulas perhaps the simplest one is, and forget the words, we don't have time to go over Ian's roses tonight, but 100% above the 200-day EMA, DMA, I mean simple moving average, 50% above the 50-day moving average. Those are simple measurements of when the high jump bar is hitting. Now I use a little bit more difficult one. I use 3 measurements: price to the 17, price to the 50, and price to the 200. This was the original and to me the best of the high jumps. I then plot that number and I look to see how close I am to the highest high in the last 200 bars. Why? Because when I have a stock that's as extended as it's been in the past, I would expect that stock, and this is the high jump here. This is a red candle high. I'm not talking about them tonight, but that's another Elliott thing. Highest high jump, highest high, the stock pulled back. Highest high jump, at the time, highest high, the stock pulled back. Why is this important to me? I don't want to buy stocks that are at their highest high jump, and I don't want to, I want to shorten my stops or sell my positions like the ATM machine if I'm getting to a point that that stock or that instrument has corrected every time in the past. So in summary, and it's a white slide, so that goes without saying, all this is related to Ian, his work, and if it's white, his slide. The whole intent is to help us understand where we are on that little circle of life, that little graph that I showed you in the beginning of the market, and phoenixes as the market pulls back, bingo, all signs of a market falling. We look for those eurekas, the bongos calling green, and then the eureka telling us it's okay to get in there long. And that really is the basics of high growth stock investing. Now, I can't do justice in 40 minutes in what these guys spend 3 weeks or 3 days doing. I highly recommend, if you're interested in this stuff, you go to the next workshop, which is March 28th to the 30th. I'll be there. I've been to almost all of them. I missed this when I was in Australia. It's in Palos Verdes. Information on the website, or email me. It's time and money well spent. Now I want to move into how I look at the market and how I attack it. I figured it'd take me 45 minutes to get through. I'm about 53, but we're okay. So why am I a top-down investor? M in CanSlim is market. Market context matters. Top-down investing because the market drives the majority of stock movement. I've seen it anywhere from 40 to 60 or 70%. How many of you made money last week being long? Probably not many, because unless you're long contras, because the market dictated performance. After market, the next most important thing is the industry group. And we can spend all day mentally going over charts and picking stocks, but they actually represent the smallest portion of the performance. So I have to look at overall market to determine my stance, long, short, or margin. I look for my favorite setups in the top industries. And then I do supplement this with a bottoms-up approach. And I use different tools to gauge what is working now. Sometimes it's pullbacks are working, sometimes it's breakouts, and sometimes it's bottom fishing. So again, white slide stolen from Ian with permission. These are permission at one time. And this is a great slide. This is a bunch of folks meeting once a month, same time of the month, on a Saturday in the library in Palos Verdes over decades. And these were all smart traders, and many of them are in the Palatuma IBD group. I've seen their names. Or they're in the area groups like Michael's. I'm not going to say anything about names, but several people that I respect who are on the HGSI board as well. And they found that if you looked at 20-day performance and 40-day performance, in a strong market, they were all stars. But the same smart people using the same tools weren't so good in a bad market. The message here is twofold. One, if the market is going against you, it is very difficult to make money buying growth stocks or buying stocks in general to the long side. Number two, and this is an argument for swing trading over position trading. most of the gains occurred in the first month, and over the next 40 days, the gains reduced. So that goes against buying and holding. You look at some of the recent leaders, the GoPros, the Alibabas, great moves followed by pretty substantial pullbacks. Nothing new, especially in a weak market, not too surprising. So I have to understand what the market is doing, and there are a number of tools that I can use to understand the market. I'm going to go over these in just a second, but I wanted to show you something else, another cool spreadsheet that comes out of EdgeRater. Every week I save within HGSI a picture of the market. It captures price, industry group, all the things that I've shown you tonight, relative strength, EPS rank, and then I could go back and I could ask questions of the data. So in 2013, so not this year, last year, I asked a question, and the question was, does ERG matter? And did buying stocks on December 30th on 2012, did buying the stocks whose fundamentals on that date showed high earnings per share rank, relative strength rank, group rank, accumulation distribution, so on and so forth, did that translate to good performance? So in 2013, again, all the fundamentals are before the year started or at the start of the year. I ignore the tails in the head because there's no stocks. It's one or two stocks. So I usually look from here to here, and what I see is it went from 20 to 40%. So clearly the higher ERG stocks outperformed. Well, that's what I expect to see. If I look at EPS rank, it wasn't stocks that got high EPS later in the year. If your EPS rank was between 90 and 100, on January 1st, you outperformed the entire year. If your relative strength on January 1st was between 90 to 100, you outperformed the entire year. Group rank, not so much, but group rank changes frequently. How about accumulation distribution? A's and B's outperform C, D's, and E's. That makes sense. And we're not going into boxes today, but my favorite box is box 7, which is turnaround stocks. Another lecture or another presentation. This is the same picture that I would have seen in 2012, 2010, and 2009. I know because I checked. I saw you that EPS rank, higher it is, the better. Higher relative strength, the better. Accumulation is better than distribution, and ERG is associated with better performance going forward. This is important stuff because it answers the question, Jeff, high ERG stocks are because they're doing well. Of course, if you back test the ones that did well, they did well when you look back. But this is forward testing where we're using the numbers before the year. Here's why your portfolio is hurting and why CanSlim and frankly, some of the high growth stock part of my portfolio hasn't been working. On the left here, based upon the fundamentals in the market on January 1st, 2014, I have a report from January 1st to February 12th. These are done in EdgeRater. They take about 3 minutes to do. What does it show me? It shows me that for this is the zero line. Again, we throw out the head, we throw out the tail. The market is break even or a small loss across all ERG. No surprise, we know the indexes. Here's the shocker. There's no correlation between EPS rank and performance. You lost money whether you had great EPS rank on January 1st or in the lower deciles. Relative strength ranked. The highest relative strength stocks did the worst this year. We know group isn't a good thing to look at. And then the stocks that did the best since January are the ones that were distributing. That is very, very strange. We've talked about it among my friends all year long. Is it they sold good stuff and bought the laggards? Is it been, Brad, I'll go over that, good question. Is it the fact that we switched to interest-bearing stocks like REITs, MLPs? I don't know, but this is the most unusual pattern, and it really suggests that you're not making a lot of money as a growth stock or CanSlim investor in 2014. Now, I looked at since this market bottomed, going back to Thanksgiving, I actually like this better because even though everything's lost money, the things that have outperformed are the best, the least bad have been the high EPS rank. The high relative strength rank did less bad, and then the stocks that are A's and B's did less bad. So worst performers are now leading to the downside. This might be tax loss selling. It might be margin calls. It might be selling losers. It might be window dressing. But at least we're starting to get a resemblance of a normal pattern. This is the year we've had. It's been a difficult year and hard to make money buying stocks, growth stocks. So let me get out of this for a second and let me move this. Now, hopefully, having two monitors isn't going to be a problem. Do you see just my scenery now where the arrow is? Hit a yes if that's the case. Okay, good. So the first thing I do is I want to know how the market did last week. Is I go into HedgeRater, and I'm not going to run the scans because they take too much. They don't take too much time. I'm just faster this way. And actually, first I'm going to go into HGSI. In HGSI, in the designer, it's a place where you could store all kinds of user groups. And yes, I'm a little bit nuts. I have user groups of things we've talked about, pocket pivots and Bible gap ups. I have things that I develop within TradeStation down here. I have things that come directly out of IBD. I have lists that come out of MarketSmith, and these are some of the MSs, I got to come up with another terminology, are actually some of my metastock searches. And I try and find the best of that I can find in the market. And then I try and look at the top 400 to 500 of them over the weekend. And then I apply my other tools to try and find what's working. During the week, I use some other tricks to cut down my time. On the weekend, this is what I like to do. One of the things that I can do retrospectively is I can do this thing called the group performance analysis. And I can identify any groups that I have, and then I can basically look at their performance from any period of time, and I get a picture like I'm going to show you now. And this is just one of the really unique and useful features in HGSI. So first thing is, on this report, black is good, red is bad. You notice any black? No. Every group in my universe traded down for the week. The S&P 500 was down 3.52%. The IBD 50 is down 3.02%. HGS 100 down 2.74. My All-Stars were down 2.63. The stocks that I handpicked, not that I necessarily bought them, were down 2.63. So that tells me something real quick, and I could also look here at the major indexes on the right and see how they performed, and really see the volatility was up the most big, silver, gold, utilities, but really the things that we trade as stock traders, they got hammered. Good week to be short. Using HedgeRater, I run my scan for the Hindenburgs. I'm questioning how we do the moving average, because when I run HGSI and my other programs, I clip this one. When I clip the fourth one, I paint a black picture. So HedgeRater I can run every night. This is what it looks like when you get the Hindi. I think we're at a position now where the problem is that we're not picking up the moving average, still going up. Something I got to talk to Chris White about. The bucketology I already showed you. I run that. How do I run it? I go into HedgeRater. I set up my S&P 1500. I go down to the right. I look at buckets report. Hit a green button, and I can count to 10 and maybe a little longer, and it's running through my analysis, creating my spreadsheet, and there's my spreadsheet. As you can see, over 20% below the lower band, 70%. There's been some updates in the data since I took the picture. Below the midline, getting close, but not to the lowest low. And I can actually step back and look at where we came from. All right, enough of that. Next thing I'll look at is the markets. Not going to go much into this, but Ian has come up with a market timing system called percent B times the bandwidth. And this is the market system here. Red is on a sell. And obviously, this is a market that's been troubling. And what's interesting is these are 8 or 10 major indexes. You could see almost in tandem, 2 out of the last 3 days, we had big kahunas to the downside across the board. So again, you come to the meeting in Palos Verdes, you'll learn all about how I do that. So I've got a pretty good feeling the market's kind of poopy. Now, I use TradeStation for a couple of things, well, for a lot of things. One of my favorite things in TradeStation is Elder put together this thing called the impulse indicator, and he uses it as a filter. If the price paints a red, then that tells him he shouldn't be going long. If the price paints a green, he shouldn't be going short. If it paints a blue, then he's free to do whatever he wants. So I want to do a quick test. So I look at the NASDAQ, and the NASDAQ shows me a red, blue on the weekly, and these dots here are MACD divergence dots. So that tells me my NASDAQ was needing a pullback because of the MACD divergence. We're in a pullback. Tells me that I am not really wanting to go long at the open unless something changes. You know, the futures are big up, I'll reevaluate. The Dow's red, weekly's red. You could see it was showing a MACD divergence. These purple and blues are John Person's buys and sell signals. There was a sell signal there. Everything is red. I can look at, well, the Russell you have to pay for now on TradeStation, but if I look at the Russell futures, they're red and red. So I don't see a whole lot of exciting thing here, do you? How about the NASDAQ 100 futures? Up a little bit, it appears this, in the early trading, painting a red. S&P 500, painting a red. S&P 100, painting a red. We all know the market's tough. These are confirming. I go on now to my charts. Now, the other thing that I usually do at this point, only because I may forget to go back, is remember all those indicators I told you about? You had the highs and lows, ISO failure, squeeze, mobile breakouts, breakdowns, Bible gap ups, pocket pivots. I have a super list of stocks that I follow, and this is a radar screen in TradeStation. The eyes mean there's not enough data because they're probably new releases. And all day long, I'm looking for evidence of something that I need to do something about. And I'm looking for, let's see, go down here. These are stocks that had Bible gap ups. Now, I get the Bible gap up 10 minutes into the day because usually they gap up on huge volume. I don't have to wait to the end of the day to know where the gap ups were. When you see Bible gap ups in VXX, TVIX, bonds, short mid caps, total bonds, it should tell you something. This market's in pain right now. I can look for mobile breakdowns in a squeeze occurring real time during the day. So I'm monitoring all those things I spent time with earlier today in the market. Back to my market understanding, I now jump into HGSI. And within HGSI, I'm going to go down to Woodward and Brown groups. These are for free that are updated frequently by Woodward and Brown. I'm going to Major Markets Plus, and we use something called the View. And the View is a combination of a filter and a ranking module. So what I've designed, or not designed, what I'm using here, Ian designed, is a module that ranks the major indexes by purely technical price and volume. Friday's the biggest weight. Monday through Friday is the second biggest weight. And the 13-day force, meaning we're going out now 3 weeks, is the third weight. And then it ranks them with this raw combo. So I look, and whenever I see bonds, silver, volatility, gold, and the dollar on top, I know the market's puking. And I look down here, I see the NYSE bringing up the rear, more proof, puke. Puke proof. That is a tongue twister. I won't say that again. So, all right, let's look at some of these indexes. S&P 500. Now, I usually start with my busy chart. And the reason why I do that, I saw kahunas on the S&P 500. That's important to me. I'm looking to see if there's any Eurekas or Phoenixes. Not being seen, I'm going to go to a cleaner view. And I've been playing with my views. And I don't want that view. I'll take that view. So I've got Hindenburgs and my moving averages. There's no volume. So if I want to be bullish, are you not seeing the HGSI? Are you seeing my chart?
It's there, Jeff.
Okay, because someone said they couldn't. I just wanted to make sure. You can see in NYS or the S&P 500. I mean, if you want to be bullish, here's why you're bullish. This is the last big pullback in 2012. This time 2 years ago it ended, or a little bit earlier it ended, to now, and we've only broken through the 200-day moving average for one short pullback in October. Big uptrend, okay? Now let's tighten this up a little bit. I had those Hindenburgs, that bothers me, and we've sold off here. So one natural bounce point could be the 50-day moving average. So, maybe we do bounce from here and we're lucky and we pull back to the 50 and we're off to the races for here for the rest of the year. I would love to see that. I'm not counting on it. Perhaps we're more likely to pull back down to here. Now, I can look in HGSI. Let me kill my taskbar here. And I just drew a line. And what that line will show me is, let me start that over again. If I pull back to say here, that is only a 3% pullback to get me down to where the 200-day moving average is. Perhaps we do this and then we bounce. So my first target as I start thinking about the market this week is, I know there's a chance, we have a big oversold condition, that perhaps we do bounce from here. Now, do I think we go all the way up? No, we're going to have to take out our prior resistance here. Or the other option is we pull back to the 200, which would be my second line of the sand. And then my third line of the sand is now we're getting into trouble. I'm going to have to put some Fibonacci's and things on. I'm not going to do that. So I look at the S&P 500. At the minimum, I'm concerned that we still may have 3 or 4% more to go. But we are at a point that you might see a bounce. All right, let's look at the Dow. Find the DJIA and not spend a whole lot of time. Looks just like the S&P pulling into the 50. Let's look at the NASDAQ. Not as bad as the others. So way above its 50. Don't like this candlestick, 2 lousy looking candlesticks in a row. We're open, traded up, and then closed down for the day. Not happy if you're long. A little bit nicer, still think the 50-day is a natural target. How about the Russell 2000? Funny thing is, holding up probably the best. As you can see, the Russell 2000 is probably right now in a trading range. Something like that. I'm not a good drawer. And of course, I ruined it at the end. So it'd be interesting to see if the Russell 2000 is at a point to bounce here. So if you want to be at all bullish, it is Christmas time. We had a big oversold occurrence on Friday. We are at good bounce points. Futures are trading up a teeny bit. I'm just not convinced it's over yet. I got to let and see the market tell me. What about volatility? Well, we'll get to volatility. I can see that volatility spiked this week, kind of a spinning top here. Is this it? Well, let's take it in a little bit. I can see going back for the rest since September of last year, this has kind of been, except for the October pullback, where we reversed. So we went a lot further, and maybe we got another 50% up to go in the VIX. And you saw they were leading with that Bible gap ups on Friday. So I'm going to keep a big watch on the VIX. You buy when the VIX is high, because when it starts to fall, that's when you make money. But you don't want to be buying when it's on its way up. I look at the dollar. Dollar has been very strong. And in fact, these are lines I was talking with my buddy John Person, and he was not as he was more calm about the dollar than I was, and it keeps taking out its highs. So the dollar is strong. We've been thinking that our economy is stronger than any other economy. Perhaps that's why the dollar is strong. I had a question about back, I believe, on the Edge Rater, how I build my market review. And I basically, it doesn't really matter what warehouse file you use, just make sure it includes all the components you want to measure and it includes all the stocks. And if you have specific questions, I can send you the one that I use, not a problem. So if dollar is strong, then that tells you gold and silver have been weak, although gold did get back above its 115 support. I think it had its strongest week in many months this week, as did silver. Now, whether they're moving up because of fear or because the dollar sold off some. So what do I know now? I've now gone through, hold on a second. Oh, I don't want to go that far. I don't want to do that. Never mind. What I know now is that I'm just going to get the slide because I like to make sure I don't forget anything. But I don't want to go through every slide to get there. So, okay. Should be if I just hit from current slide. And then I display settings. Okay. I've now looked at what's working now using the ranking within the workspace. I could have looked at internals. I didn't. I could have looked at accumulation distribution. We looked at the charts quickly. I could have looked at custom index charts. A lot of times we'll make indexes of leaders, and when they roll over, we know the market's in trouble. With Edgerator, I looked at my Hindenburg, the buckets, the market ebb and flow, and I looked at my impulse and MACD divergences with Elder. That's my market analysis. I think you can get an idea that I'm still bearish, hoping to see perhaps a bounce, but frankly, I'm not convinced I don't go shorting into the bounce if we get one. Next thing I got to understand is industry rotation. So if I'm a top-down guy, the first thing I looked at was market, and my market assessment is the market is weak. Now, are there any industry groups that are leading during this period of time? So I use HGSI. They use Bloomberg groups. And be careful, whatever software you use, you can do the same thing in them. You may get small differences that probably are not meaningful because of who their vendor is for the data. So what I'm going to do is go into 07, which is industry groups. And you can see in HGSI, I have 177 groups to play with. Now, I don't really care about what was working 3 weeks ago. And so I don't want to stay in the top down. So I'm going to go down to the 2-day force up. So it's all price and volume, 2 days movement, and what things are working. And when I do this, I can see which groups are leading the market. Now, when I think of traditional high growth stocks, tech stocks, cha-cha-cha stocks, maybe specialty apparel department stores, maybe internet. Okay, I think that's an important question I need to address. I made a comment, and the comment was about the saying is you buy when the VIX is high, and I'm not going to say anything more because I'm not sure that the rest of the story really plays through. So George Lee and I go back and forth about what to do with the VIX. So I'm going to go back to the VIX and show you what I do with the VIX because I'm sure I confuse people, and I appreciate questions because sometimes when you're the speaker, you think everybody's on the same page, and if you don't get questions or comments, then either you think people are all asleep or they may just not be paying attention. All right, so basically, if I think the VIX is going higher, I think the VIX is potentially going to go up another 50% before this is done. But then again, What do I know? I'm going to see what the market tells me tomorrow. I can buy VXX, UVXY, TVIX, which are all essentially um, buying the VIX. The VIX goes up, they go up. Okay. I can buy, if I think the VIX is going up, I might be buying contra ETFs, things that are negative to the market because I think the market is going down. When the VIX starts to fall, is when it's time to buy the market. Because when the VIX is falling is usually when you get your best gains in the market. We've had a lot of complacency with the VIX down here around 10 for month after month. The VIX is now moving around 13. That's still a long time. When the VIX goes up, as was just pointed out, you get these quick peaks. And then when it starts to run down, that's when the market typically goes up. So I do buy VIX ETFs. And in fact, somebody had a question today about ETFs. And there's a website, this is Direxion, has a list of all the different inverse ETFs. These are mostly theirs. And then there's another website here, tradermikes.net, inverse short ETF bearish ETF funds, that shows you all the different bearish ETFs and buy multiplier that you might want to use. So rising VIX tells me, correct, you could short the VIX instruments if the market's falling, or short volatility. A rising VIX tells me more volatility, puts become more expensive, and stocks go down. A falling VIX, insurance is cheaper, stocks go up, market goes up. Right now, we're in a rising VIX until we see the VIX move down. So in the industry groups, what I typically do is look at those that are to the upside and those that are to the downside. And I highlight, right-click, change to index group, and this is an HGSI, and I can look through and take a look and see if anything meets my criteria. And now I'm going to go to my busy chart, which you all should be experts at. I just got to find it. Here it is. So I think I saw today that Staples got taken for like 8.9 billion. It got taken private. So it was, yeah, it's got to be more than that. Maybe it was office supply. But these have been moving. Let me look at less data. So I'm going back, looking about 6 months. We've had a nice uptrend here. The 8's above the 17, above the 50, above the 200. We had multiple pocket pivots. We had a kahuna on Thursday, an up day on Friday. Everything is green. PetSmart went private. So there is some talk then with Staples and Office Max merging. So I see a lot to like in this chart, uptrend. It also had a Bible gap up. So very quickly I saw pocket pivots, kahunas, Bible gap ups. Everything is green. Stocks in an uptrend. The right distribution of the moving averages. I can see earnings are not out until March, so I don't have that in my face. And up here in HGSI, I can see quarter over quarter. I don't like the EPS growth or the revenue growth. This is a story where there's about trying to get these two guys to merge, and you can see a similar pattern, a Bible gap up, mobile breakout from the squeeze, and kahunas at the end of the week, everything is green. So I don't usually like to play with this unless I know a lot what's going on. These are both private equity, mergers and acquisition talk, and you might want to buy them because if it happens, they probably both go up. And it would be because the private equity thinks they can do better. Specialty apparel, Lululemon. All right, heard about that all weekend on the news as how they've turned their model around, new leadership. I guess they no longer have see-through workout clothes. Now, what do I see here? Look at a weekly chart first. And these things are fractal. Big uptrend until trouble in 2013. This is when I think they had their either missed earnings or see-through yoga pants. Big pullback, kind of a rounded bottom, and wants to go up. Bible gap, these are all weekly, everything turned green. Looks pretty nice. I got some overhead supply or resistance on that 200 weekly or 1,000 daily. I dropped down to the daily chart, and I see a stock that's really been basing for some time. Broke out, everything's green here, a couple of Bible gap ups, mobile breakout from a squeeze. Kahuna's makes money, I'm interested. I would go to quick add to group, buy watch, because I might want to look at that more. Coach, less excited. I've heard positive things about Coach on TV. I look at the chart, 200 days pointing down. Maybe it's turning around. I would pass. Urban Outfitters, interesting. So I'm going to look at a weekly chart. And on the weekly chart, I see it's really been going sideways to down. Have we put in our low? I don't know. I might want to do some research, go back into a daily. I see that my forces and my short-term bond have gone green. I like that. We had a mobile breakout from a squeeze, a pocket pivot, and a kahuna. I'm not in love with this chart because I want to buy an uptrend where the stock price is above the 8, which is above the 17, above the 15, above the 200. And clearly, okay, we're not doing that. I had a question. Let me finish, see if there's anything else here to look at. American Eagle Outfitters, not really in love with this stock, except it's got some big earnings expectations, not this piddly 4 cents for next year. So back out here, I right click. Come on. There we go. Back, and it takes me to my list of 9 things. Within this box here, I went to industry groups, which is Woodward and Brown 07, but I could have also gone in the top into this group here where it says industries. So that's where I put the parent, and then in this warehouse view, it applied my force filter, and only the high forces came to the top. The third one down is department stores. I'll take a look at Macy's. That made some of my other screens. And so as a top-down investor, and what I do every weekend on my review is I basically take a look at these stocks. I'll go quickly in a weekly. Nice, tight uptrend on the weekly, like that. I'll drop down to the daily. I see that we had a pullback here, tried to go, and it failed. Pull back here. Did have a pocket pivot. This here I haven't told you about. These are Wilder's parabolic stop and reverse. It's right below that PSAR dot. I'm going to put this on a watch list because if it breaks above that PSAR dot, it might break out on me, and that might be something I want to look at. And I would go down this list, but since we're going to run out of time soon, I'm not going to go down the whole list. I will go down every stock above the index, and I would look at each of these 10 industry groups. I do want to look at marine shipping. Something's going on here because so many of these made it to my screen this weekend, and they all are about the same. They've all been hammered. Let me put you a weekly and show you what hammered looks like. They've all been hammered. They've been doing nothing for months. And I don't get the relationship to cheap oil, except maybe people are going to be buying lots of oil, their tankers. You had a PSAR reversal. You broke out above the 8-day and the 200. You had a kahuna. Your OBV is moving up. A mobile breakout from a squeeze. Everything is green here. You make money, and you pay a 6% dividend. So this might be something that that you can see. Hopefully you're seeing my charts. I see a comment that slides are stuck. Hopefully that's not what you're stuck on. And go back to the industry groups and quickly look at the last one, which was internet-based services. And none of these are my favorites to look at. So once I've looked at the top 10 to the upside, all right, you shouldn't be on charts right now. Right now, you should be seeing the warehouse view. George, you see the warehouse view?
Yes, I am.
Okay, great. You'll point out if I'm off kilter. If I go to force down, I might find some candidates to look at for shorting. These are where the market is moving against. Telecom carriers, surprising because they pay dividends. Must be something going on with Windstream. They were trying to become a REIT, and the stock went up when they announced that. And yeah, well, it's an $8 stock, not my favorite stock to short, and probably a little bit late. It would have been nice to short it up here when it failed at this point, but it's a cheap stock, and I like to short more expensive stocks. You can't even buy puts, it's too cheap. So that's really a breakdown. You notice the bingos here, talking about the capitulation. Everything here is red, and yet a kahuna to the downside. It all comes to play. Equinix, mobile breakout to the downside. That's interesting. $228 stock, breaking below the 17. It trades at a multiple of 63, doesn't pay a dividend. I'm not going to short it at an all-time high, but I'm looking at this stock. It had a PSAR reversal. It had a mobile breakout from a squeeze. It had a pocket pivot to the downside. Its OBV is breaking to the downside. It had a kahuna down. If the market rolls over, this might be an interesting place to play, especially since it's an expensive stock with a long way to drop. That said, it's got a 50-day to move to the support in a 200, so I don't expect it to just drop to the ground. I'd rather see it dropping below those as a better candidate. Frontier Communication looks like a place it might bounce from right off the 200. So I can go through the same way through these 10 groups. I usually do the top 10 groups to try and get an idea of what's the weakest in the market at a given time. In the essence of time, I want to comment about some of my bottoms-up approach. Again, I'm a big fan of Gil Morales and Chris Catcher. And within HGSI, they have built some products for them. So I call my trading universe anything that has over $2 and 150,000 shares. And I'm going to go into some of the filters from other people. I'm going to go up here to Morales and Catcher, to their view, and I want to look at code red. So code red would be looking for stocks that might be candidates to go to the short side. So this is a bottoms-up scan using the view feature of the filter and the ranking module to identify potential stocks to go short. And it has 578. Let's look at a couple of these very quickly and see if there's anything. And I'm not the biggest shorter. I'd rather buy contra ETFs and puts, but I might want to look at a couple of these. All right, here's Merck, pull back to the 200. I'd be looking for this. I'd be looking for it to come back and test the 200 and only short it if it failed. It might bounce here, so I might watch that. NextEra Energy, still in an uptrend. You look to bounce at the 50. Costco, not my cup of tea. It's still in an uptrend. It's got that 50. But I'll circle through these, and I'll look to see stocks that look interesting from the short side. And I'm using HGSI to identify them. Now, the funny thing is, I could also use EdgeRater, and these programs to me are they may not be officially married, but they're married on my computer. And in EdgeRater, they have the code red. And the stocks that may be the best shorting candidates come up to the top. Cerner, for one, I thought was interesting. So let's go take a look at Cerner. So I could scan for potential shorting candidates and bring them into my charting platform, whatever that is. In my case, it's HGSI, and take a look at them. Now, if I thought the market was going north, going up, then I would probably be looking at the code blue scan and some of my other favorite scans that I look at to find winners. So here's Cerner that had been on my long list and recently flipped to my short list. And the reason for that is it's really broken down here. It broke down below the 50. It could run all the way down to the 200. Everything is turned red. not much in the way of earnings per share growth, about 26%, but it has a PE of 42. And this might be something I look into. Pocket pivots down, kahuna's down, everything is red. So it meets a lot of the criteria, which is why it ended up in the scan. If I thought the market was going up, then my favorite scan to look at, and almost all the things that I'm showing you, or trying to show you, come pre-made in the program. And there's one that we use from Ian and Ron. Oh, where's it at these days? Actually, this one is from my buddy, David Gallardi. It's in here somewhere, but I'm just going to go pull it out of mine because it's in mine as well. And it's sprinters. So if I wanted to go long, um, if I wanted to go long, I run some of my favorite scans to the upside. Centene I've been talking about for months. And this is a stock or a company that's involved in Medicare and Medicaid. They're a big winner in Obamacare. And they had a great number this week and had a mobile breakout from a squeeze. Kahuna's pocket pivots, everything is green. I've been talking about this as it came up off the 50 as being a good time to go long. It was, it probably still is a good time to go long. So I have a number of scans. Now, the HGSI community is that, it's a community. Anything I have, you can have on HGSI. Everything is freely shareable. We do this to help each other out. It's really about the community. Now, my trade station scans, no, I paid money to develop those. They're not free if I offer them at all. I have created some volume buzz scans looking for 5x and 3x volume. DHT Holdings, I talked about the marine shipping stocks that were breaking out earlier. Here is a marine shipping stock, and same pattern, downtrend. Something happened 4 days ago, turning green. Doesn't look that exciting on the earnings front, and it pays a 1.2% dividend. And the other one that had high volume, breaking out on volume, was Organovo, 3D Printing Life Sciences. God only knows whether about the 3D technology in healthcare, but a lot of people like this. A couple of great questions here. Can you moving earnings data to other windows rather than having it scroll through? Yeah, that's a question I put to George today. It's something he's working on. There's other things that are more important, like helping make more money by finding better stocks. But I pointed out we have a lot of white space here. I want the industry group, the sector. I want its EPS date. And I like him since he has bar chart data. He should be able to tell me not just the next 2 quarters, but I want to know 2014, 2015, 2016 annualized, and I want it all on this page. So believe me, I've been asking for it, and I know George, he's very supportive of all of us, and hopefully he'll get that for us at some point. So that was my bottoms up. I mentioned a little tickler about seasonality and Netflix. Let me go into that one because we're getting to the point where you guys are probably getting tired of listening to me. So let me close all my stuff down, and boy, I got a lot of stuff there. And let me pull up Magenta Trader. You can do seasonality in Thinkorswim. You can do it really well in Genesis. I'm not convinced that you can do it well in any other program, and frankly, I'm not sure it works that well in Thinkorswim. It's one of the things that I'm willing to spend money for. The concept of seasonality is simple. Why do we have the sell in May and go away rule? Because more years than not, the market sells off in May and you buy it back in late October. So that's seasonality. When oil, I shouldn't talk energy, when you switch from air conditioning to heating, there's a different oil that needs to be made. When the refiners go through the changes, that affects the price of gas, the price of oil, and energy stocks. That's seasonality. If you believe you want to buy Macy's because it's Christmas time and it always does well with the Christmas season, that's seasonality. Well, it turns out there's repetition that occurs in stocks, sectors, the market. And for example, I killed it. You go back into my Excel spreadsheet because you have not to be critical, but I'll call it a simple version of seasonality in EdgeRater. So I can take any list that I want to look at. I can run the seasonality screen against it. And I can look, first thing is, I ran it on Friday and I said, based upon seasonality, going back as many years if I have data, what in the next month, what's the likelihood of trading up? So XLV, 15 years out of 15, it's been up and an average of 3% over the next month. Energy has been up 10 out of 15 years, 1%. So I could look at the sectors and I could rotate them by number of years positive. I could also be by highest return. It happens to be the same one. I could also look at stocks. So I looked at a lot of stocks. And everything on this screen, Cigna, Deere, big stocks, XLV, Healthcare Select Spiders, each of these stocks has a high propensity to be positive in the next month. And you can see 12 to 0 up, 11 to 1, 11 to 0. So you might want to go searching in stocks that have a tendency to go up this time of year. Over here, I ranked them by percent return over the next month. Actually, nope, they're ranked the same way. I meant to do it by percent return. I pasted the wrong one, dummy me. So one way then is to run seasonality and EdgeRater against the entire market. The other one is to actually go out and buy a seasonality program. The advantage of a seasonality program is that the algorithms are better. You can scan the market, you can build calendars, and you can get an idea of when things are working, and you might want to prepare. There are certain trades during the year that go to the bank trades. One of them is Netflix. Now, Netflix, here is a chart over the last 6 months of Netflix. It's clearly in a downtrend. Down here is predicted pattern of 5-year and 10-year seasonality. 10 is in yellow, 5 years is green. The red scans for the weak part of the year, green are when it's time to be long. And what you have here is a mid-January, third week of January historical event occurs with Netflix. And it's around their January earnings. Now, how good has seasonality been on Netflix? If you bought on January 19th and sold it on February 27th, 9 out of 10 years you were up. On the year you were down 0.3%. It's only one, so average is what you were. But you were up 26.6% if you took on the up years. Overall, if you made the 10 trades, you'd be up 63%. So what seasonality is predicting is that based upon the last 10 years worth of data, that Netflix has a major seasonality reversal in January. Now, it used to be, let's see if I can do this. That's the data. Let's see. How about Navigator? I could look at individual years. Here was last year. Last year, the stock was not doing well. And but you can see in the white line, once I take, all right, I'm going to turn all these off. All right, that was a predicted seasonality. And that white line is what happened last year. So I talked about it on the board. George Lee talked about it. And hardly anybody we know took the trade, but those that took the trade all thanked us. Why? Because it went up 20% after earnings. So you're playing. If you're in Vegas, and I told you that 9 out of 10 times you're going to win this trade, and that it's going to go up 20%, are you likely to take the trade? Yes. And that's what seasonality is about. It's finding those unusual stocks that have fabulous seasonality. And I'm not going to ignore the chart pattern. I bought calls in the money 5 minutes before the market closed when earnings came out that afternoon. I believed in the seasonality, but I didn't know where the stock was going to be trading because it was all over the place last year. They have a calendar built in here that basically goes by date and identifies those that are entering a seasonally strong. And I set my criteria for both strong and weak, minimum of 10 years data. Let's set it to 100%, and only if they went up at least 5%. So let's look at something that I recognize, Paraxel. 5 and 10 year seasonality. Here's a stock. It's in an uptrend. It's at the bottom of its channel, and it's about to go into a very seasonally strong period. How strong? I got to put this on my buy list. If you buy it December 18th and sell it January 28th, and you did it each of the last 10 years, you were right 100% of the time with an average return of 18.9%. Not too shabby, is that? All right. And so I might want to look through and identify. Notice there's some keys there. Let me find one that maybe doesn't look so good. I don't know what they look like. I'm just looking at stocks that I know that move. I'll just pick something. EEP. All right. So I'm going to look at the last month or so. So I've got in a range. Here's some type of a predictive model of where the stock is going. So it's channeling up. It's at the bottom of its channel. It's entering a seasonal strong period of time. Enbridge Energy, obviously you don't want to be buying an energy stock now on the basis of seasonality. Up 8 out of 10 years, numbers not so good. All right, that's another one, but I would skip that one. I really do like the Paraxel, and I like the Netflix. The Paraxel is a closer one. So you basically can use the calendar to screen for stocks that are meeting certain criteria. And you can also take your favorite stock of buying. So let's say I was thinking of buying HLV. So I put HLV in. I guess that's not what the sector is. XLV. XLV. And the proprietor does some excellent education on these. So here's the channel. So I'm heading down in the channel. I'm in the midst of a strong seasonal by the green. The green and yellow line are moving up. 10 out of 10 from December 1st to January 9th, up, average return of 4.8%. Not great, but not bad. So basically, what I'm trying to do is I'm trying to use additional bottoms-up tools to help me find what's working in the market. Now, I'm just about finished, and I can't believe I still got 90 people still on the line. So we've looked at the stock analysis. I build my watch list. This is what I like to buy, not JNUG. I want stocks that have pulled back and are breaking out. Everything turned green. I had a mobile breakout from a squeeze, a kahuna on volume taking out the 50-day moving average. LCI, uptrend, pullback, and I got into it here because I had a mobile breakout from a squeeze. I started turning green above. I had a pocket pivot. I also, a couple days later, had a kahuna, kind of a pocket, a cup and handle coming in. I talked about my bottoms-up analysis. You need to have a trading plan, which is subject of a whole different discussion. And just lastly, if I whet your appetite, we do have this meeting coming up February 7th to 9th. It's open. I have several more spots left. It's $800 for 3 days. There's HGSI has free trials. EdgeRater has free trials. I don't know if Magenta has free trials. Everything that we talked about tonight, plus George Lee on steroids, talking about how he uses FinViz Thinkorswim to supplement HGSI, will be discussed, and would love to have you guys join us. So on that note, I guess it's time to answer any questions that anybody might have. We've been doing them all along. If there's something you wanted to ask and you're playing this back, just email me at hgsidoc@gmail.com. That works. You're welcome. I love doing these. How do I weigh the market direction? I weigh it very heavy. And if we were in an uptrend right now and I thought the sky's the limit, i.e. coming off the bottom in October, then I would look at that 50-day as being support, and I'd be looking to go long. I would see the futures are up a teeny weeny bit, and I'd be excited. I think we've got a few more days. Now, I'm not a Fibonacci guy, but I saw an interesting video this weekend of Fibonacci timeframes, and they predicted 3 to 5 more days before the market turns around based upon Fibonacci time. Who knows? I think the 200-day is too compelling. It's only 3% away. And to me, that's the heaviest point. So I've got a shopping list, but I've got nothing I'm putting out there to buy until I see what the market does. And the other thing that I'm monitoring during the day is I'm monitoring things that I may act on, such as the 3X bears, the 3X bulls, looking for pocket pivots on them and the other symptoms. So you can tell I'm a doctor. I'm looking at what sectors are working well. So I use various things during the day, but I think that market is the scary part. George will have to answer the timing of delay. I know we're going into beta very soon, which is exciting.
Before the end of the year, 15-minute delay.
George, you know that is 2 weeks.
Yes, I do.
All right, that's a great answer. We heard it here. And more people want more information in the free space on both of the charts. And somebody actually suggested, I'm all for it. Make my life easier, get rid of different programs, as there's a lot of empty space in the warehouse view that we potentially could use as well. The beauty of HGSI is that everything that I did, I can scan for kahunas. I can scan for eurekas and bingos. I could create charting colors for any. If I had a filter that I liked, that I could create a chart indicator for that filter, that every time that I trigger that filter, it would paint it on a chart. And that would allow me, let's look back here, it allows me to sort of get an idea if those signals work. So it's the flexibility there. As I said, to me, I use EdgeRater and I use HGSI. I couldn't live without either of them. I guess if I had to choose one, I'd have to live without EdgeRater, because HGSI is sort of the, again, talking doctor, the nucleus, the head, the center of everything that I do. But I'm able to go back and look in time and get an idea, sideways movement, PSAR reversal, kahunas, eurekas, it goes up. Just to get an idea of what I'm filtering for, applying them to a chart and getting a sense of what they do. I have Metastock and other programs. And other options you could do. I just see AA canceled their evening flight Monday to DFW. Well, there's always Lauderdale. I guess that's in regards to my meeting. Phone numbers for support numbers on the program are on the website, right, George?
Yeah, yes, they are. I think that question has a little bit more depth to it about wanting to add consultation over the phone.
Well, Mike, the best thing I could recommend, well, first thing is there's a big family of users, none of which are paid, that help George out as much as we can. And there's sort of a selfish reason to do that. And the selfish reason is that we got to keep George around to improve the program and invest in the program, and that requires people to pay for the program. So if we can get people interested in the program, getting them using it, that's a home run. If you want to really learn, you go to Palos Verdes, or you come to my meeting in Florida, or you go to both. That's will jumpstart your learning. If you email me, I'll send you, if anybody wants to email me, I did 6 educational videos that I looked at each of the buttons in HGSI and how we use them. I'm happy to share that, hgsidoc@gmail.com, or if you email George, he'll get it to me. But come to one of the live events because you'll find you learn more from the other people there than you necessarily do from me. And I think we're pretty good on the questions. Well, it went longer than I thought. George is going, yeah, right. It went 2 hours. I appreciate everybody being here. I hope you learned something. Again, there's a program that I love. You can tell I used it here tonight. But it's really about the philosophy of trading that we've learned from Ian and Ron, and really based a lot on the work of O'Neill. And the best part about Morales and Catcher is Morales comes to the PB meeting. He lives right down the road. He won't come to Florida. It's too far. Hope you guys got something out of this. And look forward to seeing you at a live meeting sometime. Thanks, everybody. Thank you, George, for putting this on.